So as promised, Matthew Warren's here with business today. All eyes on Italy. Fresh instability there, isn't there?
Yes, that's right. One political analyst saying that Italy could be heading towards Greek-style instability. Now, that all follows the decision of Prime Minister Mario Monti to step down a bit earlier than he had originally planned to. And there are fears that this period of relative stability that there's been in Italy could now be under threat. Now, what does that stability look like? Well, one thing we look very closely at are these bond yields. That gives a sense of investor sentiment towards Italy, and those have been coming down in the year since Mario Monti has been Prime Minister. They were well over 7% a year ago, now at a 2-year low. But the real problem for Italy is its huge debt pile. Only Greece has a higher proportion of debt to GDP, and that's continued to rise. But under the plans that Mario Monti's put into action, that's expected to peak next year at around 127% before starting to fall.
So is it working? How's the economy doing?
Well as debt, growth has been the other real problem. It's just not been strong enough. Growth, the economy is likely to contract this year by 2.3%, and next year it will also contract, not by as much, about 0.5%. And the other thing to look at, of course, is unemployment. What's the effect been there? Well, that's been on the rise as well, as it has in most countries in Europe. That's now just over 11%, and for young people it's even worse, around 1 in 3 out of work. Well, as I said earlier, one political analyst says that there are risks of undoing some of the good things that Mario Monti is believed to have done so far.
Is not good news for Italy. It means that all the austerity measures which Monti has put through over the last year could be for nothing, and it means that we are possibly heading towards Greek-style instability.
Yeah, you mentioned Greece there. We're going to stay in Europe. Greece hoping to get approval for payment of a loan instalment later this week.
Yes, a loan instalment it desperately needs of 34 billion euros to pay all sorts of bills. Now, one of the conditions of that is cutting its debt pile with what's known as this buyback. It's aiming to cut about 20 billion euros of debt, and it's going to do that by paying back about 30 to 40% of the value of some bonds. Well, a successful buyback is crucial if it's to get this payment. And the Greek Prime Minister was in Germany on Sunday. He said he's feeling pretty confident that the buyback is going well.
I think that developments show that we can say by Monday or Tuesday with most certainty that the program has worked.
Let's flee the Eurozone for a moment, shall we? Some mixed news on the state of the Chinese economy.
Yes, which we also watch very closely to see what's happening there. And some mixed data out from China. There was some positive news when it comes to industrial production, what's coming out of factories, up 10%. Retail sales also up. Now, those were the highest figures for about 8 months. But enthusiasm over those figures is tempered a bit by the latest data on exports. Those were up 2.9% for November, but that was much lower than expected. Imports flat as well. So if there is a bit of a recovery, what that suggests is it's still very fragile.
OK, markets open, of course, in Asia. How have they been digesting the news?
Yes, well, let's take a look at those and we can see what Shanghai has been making of the numbers as well. And overall, on balance, Shanghai is pretty positive about that. The Nikkei, though, you can see there virtually flat. Now, one of the things going on there is some fresh data out this Monday saying that the world's third largest economy shrank in the 3 months to September. GDP was down by 0.9% in that period. Now, that means that Japan is technically in a recession again. Now, many problems afflicting Japan. Global demand weaker, of course, but also the yen is strong, too strong for Japanese exporters, and they've been hurt with this territorial dispute that they've had with China. So all eyes will be on the Bank of Japan to see whether they try and move that number in the right direction with some more monetary easing later in the month.
OK, a little bit closer to home for us anyway, here in Paris. The UK has kind of been struggling, hasn't it, to get out of recession, and its retail sector, it's still suffering.
Yes, and an announcement last week that there'll be 5 more years of austerity from the British finance minister means more belt tightening likely for consumers. Well, that's all taking its toll on the high street, as Jen Carswell reports.
Oxford Street, central London. Not only a shopping supercentre, but the quintessential high street, a hub of all things retail. But an hour from the capital, the story is very different. These signs of abandonment and disarray paint a worrying picture.
Anything else?
And shopkeepers have good reason to be worried.
When we moved in here, that was 6 years ago, all these shops along here were full. Business was booming, and then as you know, the recession took its toll, they all closed down one by one.
An average of 20 stores a day shuttered permanently in the first half of the year. 5 of the UK's biggest brands left the high street for good, with thousands added to the already long list of job seekers.
High street that in the past had Marks and Spencer, Boots, Next, etc. Unfortunately, that sort of high street is a thing of the past. The first thing that's really killing the high street in some ways is the internet. More and more people are using the internet as a way to find cheaper prices.
But a group of industry professionals is looking into how to revitalize these areas.
How we use our town centres is changing. So many towns are now functioning in a very different way, and we've got to adapt those towns so they're fit for the next 50 years. So it's quite a major point in our history of town centres.
The holiday shopping season is getting underway, though slowly. With consumer spending making up 2/3 of the UK's GDP, the government is hoping that by illuminating the problem and hitting it head on, it can bring back the public before it's lights out for the high street.
Jen Carswell in London there. Well, let's get some of the day's company news. And the biggest ever foreign investment by a Chinese firm looks likely to go ahead. Oil giant CNOOC will be allowed to take over Canada's Nexen. The $15 billion deal has been approved by the country's regulators.
The mayor of New York, Michael Bloomberg, is considering a bid for the Financial Times. That's according to reports in the New York Times. Now, Bloomberg made his fortune with the business news empire that carried his name. Analysts value the Financial Times group at $1.2 billion.
And France's PPR Group is buying a majority stake in the Chinese jeweler Qilin. The company currently has 14 stores around the world. PPR, which owns brands including Gucci and Yves Saint Laurent, says it has great ambitions for the brand.
And a story for you now that a Belgian village has acquired, taken in, a rather famous French export.
Yes. How would you feel if you stepped out of your nice little country house in the village of Nishan and saw Gérard Depardieu walking past on his way to the village shop, perhaps? Well, that's what they'll have to get used to in Nishan. The mayor there has confirmed that, Gérard Depardieu. We heard rumours before, but it's been confirmed that he is buying a house, and you can see the village there. Now, why is he buying apart from the beautiful landscape? Well, it could be that Belgian taxes on the wealthy are much more lenient than in France. They don't have, for example, this new 75% tax on people earning more than €1 million. So could be that, or perhaps it could be the fine wine and other benefits of the area.
They don't all wear pigtails in that area. That was a clip from Asterix, wasn't it, that he's in? Just to explain. Matthew, thank you very much. Matthew with the business. Morning's coming up after the break. Stay with us.